Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Oklo.
If you find our talks useful, please consider subscribe, like, and comment underneath. And before we really get going, I want to quickly mention StockOracle. You can find a special 14-day trial link below in the description.
Yeah, and just a quick heads up, that is an affiliate link, so we might earn a commission at no extra cost to you. StockOracle is it's an AI-aided stock research platform.
Right. Definitely not financial advice or like a trading signal service or real-time market data.
Exactly. And, as always, AI insights and valuation estimates, they can be incomplete or just plain wrong.
Yeah, so always make sure you verify important facts yourself. Okay, so let's jump right into this. We are looking at Oklo today. The ticker is OKLO.
And this is a wild one.
Oh, it really is. I want you to imagine a company that is currently valued at nearly $6.8 billion.
Huge number.
Right. And their mission is to build the future of advanced nuclear energy. Basically, to feed the massive, seemingly limitless power demands of the AI industry.
It sounds like a sci-fi dream.
It totally does. But there is a huge catch here. This multi-billion-dollar company currently generates absolutely $0 in revenue.
None. Not a single cent at the top line.
Zero.
We are looking at a pure early-stage development valuation here.
Yeah. So today's talk is all about figuring out what is really going on underneath the hood. We want to know if this stock is, the ultimate foundational play for the AI power boom, or if it's just a massive speculative bubble waiting to pop.
Because honestly, looking at these baseline numbers, it's tough to wrap your head around.
It really feels like buying a multi-billion-dollar lottery ticket, right? But the drawing hasn't even been scheduled yet.
That analogy holds up surprisingly well when you actually dig into the financials.
Right.
Because if you are following the energy demands of big tech and AI, specifically understanding Oklo is pretty essential.
It really is the main bottleneck.
Yeah.
Exactly. The broader conversation is always about semiconductor chips or data center construction. But the true physical constraint on all of that is power. Reliable baseload power.
So let's start with just the basic survival of the business. To understand how any company operates with literally zero revenue coming in the door, we have to look at its bank account.
Yeah, their spending habits are fascinating.
The income statement doesn't even bother with a revenue line. It just goes straight to operating expenses.
And those expenses, they tell a story of really rapid scaling. For their fiscal year 2025, total operating expenses were approaching $140 million.
Wow.
Yeah, it's about $139.3 million to be exact. And breaking that down, you've got roughly $59 million directed just to research and development.
And a ton going to admin, right?
Yep, another $80 million flowing into general and administrative costs. That total is a massive leap from the previous fiscal year, 2024, where they spent just over $50 million in total. So they aren't just burning cash, the burn rate is actually accelerating fast.
Extremely fast. All that spending resulted in a net loss for the year of over $105 million.
Which is, what, like 72 cents a share in pure losses?
Right around there, yeah. And looking ahead, it doesn't seem to be slowing down at all. In just the first quarter of 2026, they burned through more than $50 million.
Just in one quarter.
Yeah, and management's own guidance projects, they'll use between $80 to $100 million in pure cash for operating expenses through the rest of fiscal 2026.
I mean, obviously, navigating the nuclear sector requires an army of specialized engineers, top-tier regulatory lawyers, and none of that comes cheap.
Not at all. That kind of talent is incredibly expensive, hence the swelling administrative and R&D costs.
But to evaluate this fairly, we have to look at the other side of the ledger, because they have what you'd call a fortress balance sheet, right?
It is an absolute fortress. As of March 2026, Oklo held $2.54 billion in cash and marketable securities.
Wait, I need to pause and do the math on that. $2.5 billion.
Yeah.
If they are burning, let's say, $100 million a year, but they are sitting on a war chest of $2.5 billion, they could theoretically burn cash at their current rate for over 2 decades.
2 decades without needing to make a single dime in profit.
That is insane. Are we looking at a tech startup here, or is this just like a dragon hoarding gold in a cave?
The dragon analogy is probably spot on. Because get this, they carry zero bank debt.
No way.
No corporate bonds, no restrictive debt covenants that might force their hand. Their total liabilities sit at roughly $65 million.
Which is literally a drop in the bucket against $2.5 billion.
Mechanically speaking, their cash runway is phenomenal.
But, I mean, there has to be a psychological limit to that, right? A business can't just burn cash in a vacuum forever.
Well, the psychology of the market is the whole ballgame here. Being a pure cash burner with zero revenue means the market is operating purely on faith.
Because you can't value them on earnings.
Exactly. Earnings do not exist. Investors are valuing this company based on a probability matrix like, what is the likelihood that this massive cash pile actually translates into commercial nuclear reactors?
Which brings up the biggest question for me. If they have years of cash secured, what exactly are they spending it on?
Well, it's not commercial power plants, that's for sure.
Right. They aren't pouring concrete for commercial clients. They seem to be funding this endless regulatory waiting game.
Yeah, their primary competitive differentiator right now isn't some super secret proprietary tech. Their moat is really their early mover status with the Department of Energy.
The DOE pilot programs.
Right. They built the GROWS test reactor at the Idaho National Laboratory, and they took that project from a greenfield empty site to substantial completion in just 10 months.
10 months. In the nuclear world, that is staggering.
It really is. It proves they have tangible executing capabilities. They even got startup authorization for the DOE, which clears the way for fuel loading and achieving first criticality.
And for anyone who isn't a nuclear physicist, first criticality basically means the reactor has achieved a self-sustaining chain reaction. It's officially turned on.
That is a massive physical milestone. But, and this is a huge but, we have to make a crucial distinction about how they move so fast.
Because it was on federal land, right?
Exactly. They built it under the direct authority of the Department of Energy. By operating in that specific government testing program, they bypassed the civilian licensing route.
Overseen by the Nuclear Regulatory Commission, the NRC.
Right, the NRC.
So wait, if they built a functioning test reactor in 10 months, why can't they just replicate that blueprint for a commercial client, like an AI data center?
Because the moment you step off protected federal land and try to build a commercial plant near civilian populations, the DOE no longer has jurisdiction.
You have to answer to the NRC.
And their mandate is strictly public safety, environmental impact, security, and their process takes years.
Years. Which leads us to the major red flag we found. The NRC actually denied Oklo's original license application 4 years ago.
Yep, 4 years ago. Now, they did recently get their principal design criteria report accepted for an expedited review.
Which is a minor positive step.
It is, but the fundamental issue is still there. As of their quarterly report filed in May 2026, Oklo still had not submitted a refiled license application.
That is wild. We are 4 years past the denial and the new paperwork isn't even filed.
Not even in the system.
4 years to refile paperwork for your core business model. That completely changes how I view their customer agreements.
It really does paint a different picture.
Because they list all these impressive-sounding partnerships, letters of intent with companies like Equinix, Diamondback Energy, Prometheus Hyperscale.
Oh, and the big one, the 1.2 gigawatt prepayment agreement with Meta for an Ohio campus.
Right. But the critical detail is that Oklo has exactly 0 binding power purchase agreements.
None. A letter of intent, an LOI, is basically just a formal expression of interest. It is not a legally binding contract to actually buy electricity.
Whereas a power purchase agreement, a PPA, is the ironclad contract that actually bankrolls the construction.
Exactly. That's what guarantees future revenue. Oklo has none of those.
I mean, if you're Meta, signing a non-binding agreement is just fantastic PR. It signals to Wall Street you're aggressively pursuing clean energy.
Right. It looks great on a press release.
But if Oklo hasn't even filed their basic NRC application yet, isn't Meta's agreement just a very expensive placeholder in a line that isn't moving?
That's a very fair way to look at it. The LOIs do prove there is desperate demand from big tech. The customers are waiting at the finish line.
But when are they actually going to cross that line?
Well, management's own disclosures say that their target of deploying a first commercial plant in 2028 is ambitious.
Ambitious. Yeah, that's standard corporate speak for do not hold your breath.
Yeah, and the risk factors section of their filings is even more blunt. They literally state it is uncertain when, if at all, they will obtain NRC approvals.
So their competitive moat is a regulatory pathway that they haven't officially re-entered?
Pretty much.
So if they are trapped in this holding pattern, how are they keeping that $2.5 billion war chest topped up? They aren't selling electricity.
No, they're funding themselves through equity dilution.
Ah. The great dilution machine.
Yes, and the pace of it is incredibly aggressive. At the end of 2024, their total share count was 137.7 million.
Okay.
By July of 2026, that number ballooned to 184.8 million.
That is a 34% jump in the total number of shares in just 18 months.
And to make matters worse, they have an open at-the-market offering authorized for a massive $1 billion.
An ATM. So they can just quietly sell newly created shares directly into the open market on any given day.
At the current market price, exactly. It acts as a constant ceiling on the stock. If the price rallies on good news, they just sell shares into that buying pressure to raise cash.
Which pushes the price right back down. It's like slicing a pizza into more and more pieces to feed a growing party, but the pizza isn't getting any bigger.
Your individual slice just gets thinner and thinner. Dilution directly erodes shareholder value.
And we have to talk about where some of that value is actually going, because it's not all R&D. Stock-based compensation is soaring.
Yes. In the first quarter of 2026 alone, they paid out almost $16 million in stock-based comp.
Compared to what, like $2.3 million the year before?
Exactly. So while the retail investors are getting diluted, the insiders are getting paid.
And the same insiders are quietly wrapping up their own pizza slices to take home. The insider sentiment here is glaringly bearish.
Over a 90-day period, insiders sold a net 876,000 shares.
Wow.
The ratio was heavily skewed. 36 insider sell transactions compared to only 14 buys.
Now, obviously, executives sell stock for lots of reasons. Paying taxes, buying a house.
Sure. But context is everything. When you see consistent heavy selling by executives into a stock that is already in a severe downturn, it signals a distinct lack of conviction.
Right. The people who have the deepest understanding of these regulatory hurdles are choosing to take cash off the table instead of buying the dip.
Exactly. And that behavior perfectly aligns with the broader market sentiment. Overall sentiment is officially classified as neutral-leaning cautious.
Even the historically bullish analysts are pulling back, right?
Yeah, Barclays recently maintained an overweight rating, meaning they expect it to outperform eventually, but they quietly lowered their price target from $82 down to $76.
The market is realizing a long-term story isn't enough right now.
Right. Positive milestones like the DOE authorization are constantly overshadowed by the immediate reality of dilution and regulatory delays.
And that is reflected in the chart. A 78% drop from the highs is just brutal.
It really is.
The stock hit a 52-week high of nearly $194 back in October 2025. And now it's trading down around $42.
It's a combination of the dilution mathematically lowering the value of each share and investors realizing revenue is years away.
The premium they were willing to pay is just gone. Completely
Compressed, the stock is trapped in a pronounced technical downtrend across virtually all time frames.
Now, I did see there was a recent 8% bounce off its 52-week low of roughly $36.
Yes.
But seeing the stock up 8% in a day, if you're a retail investor holding the bag, that feels like a win. But if you zoom out, celebrating that is like finding a $20 bill on the sidewalk right after losing your entire wallet.
That is the perfect way to put it. The structural pattern of the chart is unbroken. It's just lower highs and lower lows.
And the volume on that bounce was terrible, right?
Yeah, the volume is only 0.7, 4 times its daily average. A low volume bounce from a low is typically just an oversold rebound.
Shorts covering, basically.
Right, aggressive selling momentarily exhausting itself. It does not indicate a true trend reversal or big institution stepping in.
So with the chart looking this broken, what could actually turn the tide? We've got Q2 2026 earnings coming up.
True, but given the trajectory, earnings are unlikely to be a positive catalyst. The market fully expects continued operating losses and cash burn guidance of 80 to 100 million.
It's just confirmation of the financial bleed.
Exactly.
What about physical milestones like fuel loading and first criticality at the Groves test reactor?
Well, that's a massive engineering feat. But again, that's the DOE pathway. The market already priced in Oklo's ability to operate in a protected federal sandbox.
Right. Investors want progress on the civilian NRC pathway, and that timeline is still completely blank.
Which leaves investors relying almost entirely on macro catalysts, things like jobs reports, inflation, or semiconductor capex from big tech.
basically just clinging to the overarching narrative that AI needs power.
And relying on macroeconomic trends to support a pre-revenue company is an incredibly dangerous game.
Absolutely. Because if the broader market shifts to a risk-off environment, speculative growth names like this will get dumped regardless of AI hype.
Right. If investors decide they want safe, cash-flowing assets, Oklo faces severe selling pressure.
Okay, we've covered a ton of ground today. Let's bring it all together for the final verdict. Based on our analysis today, the overall investment stance on Oklo is firmly neutral, leaning cautious.
Yes, the rating comes in at a 4 out of the scale, placing it in the lower, riskier band of neutral.
Now, to be fair, they have real engineering milestones. The DOE authorization is huge.
And the $2.54 billion cash fortress guarantees they can survive for years without profit. That is a real long-term positive.
But the downside risks are massive. Pre-revenue burning $100 million a year.
Yeah.
Zero binding PPAs. And retail investors are suffering through insane dilution while insiders sell.
And most importantly, that NRC license reapplication is 4 years overdue. That accumulation of risk is why the $6.8 billion market cap is so precarious.
It completely prices in a perfect success scenario.
Right. So we're not telling you to buy, sell, or hold, but if you're looking at this as a long-term play, buying the dip just based on hype is a gamble.
You really need to wait for concrete evidence. Specifically, 2 non-negotiable events. First, the actual confirmed submission of that NRC license application.
They have to get back in the regulatory line.
And second, the conversion of at least one LOI into a legally binding power purchase agreement. Until someone actually commits capital, this is just a remarkably well-funded science project.
Those 2 milestones are the dividing line between a speculative story and a viable commercial business.
Which leaves us with a much larger question to ponder. We started by discussing how power is the ultimate bottleneck for AI. If a frontrunner like Oklo, with $2.5 billion in cash and Meta as a partner, is openly admitting 2028 is ambitious.
And they don't even have their paperwork filed.
Right. What happens to the broader AI supercycle?
That is the defining question for the tech sector right now. If the power isn't there, the data centers can't function.
Will big tech be forced to abandon clean energy and pivot back to fossil fuels? Or will the entire AI revolution find itself bottlenecked by the grinding wheels of civilian nuclear regulation?
It's definitely something to watch closely. Keep your eyes on the boring regulatory news, not just the flashy press releases.
Exactly. Well, that wraps up today's analysis. If you found this helpful, please remember to subscribe, like, and comment underneath.
And don't forget to check out that 14-day trial link for StockOracle in the description below.
Thanks for listening. Remember, until the drawing is actually scheduled, a lottery ticket is really just an expensive piece of paper. Catch you next time.